A beginner's guide to reading the candlestick charts on Poloniex. So Poloniex is the cryptocurrency exchange, very popular cryptocurrency exchange, and somebody asked me in one of the other videos that I'd done, they commented on YouTube, could you explain the chart, this main chart here, to show the candlesticks and so on. So I thought I'd put together this video. Hopefully you find this useful. Like I said, it is a beginner's lesson. I'm no huge trader. I do trade cryptocurrencies. I love trading, but it's not my full-time profession at this stage. So here we've got the candlestick chart. Very simply, the green candles indicate a price that goes up. A red candle is a price coming down. Now, if we just scroll down the page here a little bit, we see I'm set at the moment on the 30-minute chart. So each candlestick represents 30 minutes. They're called candlesticks because they look like candlesticks. The Japanese invented the candlesticks, and they just give you a quick representation. So here you can see there's 3 candlesticks going down, showing a degree of weakness. The candlesticks try to come up, they don't reach the highs of that previous candle, and it falls again there. Then we get a reversal here, comes back up for a little while, and so on. So you get up and down, and essentially a red candlestick, what it shows is the highest price, which is the top of the wick. So that's the highest price on this particular candlestick here, and the lowest price. And you've got the open and start price. The open price on a red candlestick is at the top, so that's where it opened. It presumably went up a little bit, then came all the way back down, and then went back up a bit and finished at this point here in this half-hour period. So it went up a little bit, fell down, came back up, and so overall in that half-hour period it was down by that margin. And you'll see that the next candlestick basically opens at the close of the previous one. So we've got this level here, that's where it opens. The price would have fallen at some point in the half hour, gone back up, reached a high at the top here, and then come back down to finish this half an hour here. And you'll see again moves on to the next candlestick, which is a red candlestick here, and that is the open price, was the same as the close price of the previous candle. So you'll see that that always follows. On a red candlestick, the next opening price will be at the bottom of the candlestick, and again, so at the bottom of this one, that was the actually the price did shift there quite a bit. There's what's called gapping, so it gapped there and then rose up, and then from there it went along and rose up again, and so on. So what are all these other symbols and lines on this chart all about? If you go to the tool section here, you can see we've currently got the SMA, which is the smoothed moving average, and the EMA, the exponential moving average. The exponential moving average puts more weight on the average based on the more recent movements in price. So there's more weight of the moving average on the current changes in price compared to the older ones, whereas the smoothing moving average is literally just taking the average of the last 50. So at this point here on the blue line, right at this particular moment in time, that would have been the average of the last 50 candlesticks, and that would have taken you to that point there. So those are those two. You can change the periods. So if you wanted to have 100 on the moving average, for the smooth moving average, you'll see this line gets a lot straighter. If we just expand this out, let's just remove that off of there for now. And the way to see more of the chart here is just to come below in this section here and just move the two sections. So we can see there the blue line is the smooth moving average of the last 100 periods, whatever time frame you're on, so 30 minutes. So that's the last 100 times 30 minutes. So what's that? 300 minutes? Sorry, not 300 minutes, 3,000 minutes worth of readings. So you can see that's a very smooth line. And what some people might want to do with that moving average, when you've got a price that's risen above the moving average, comes back again, then there may be a rise after that point, and that'd be a good place to buy there. And indeed it did. It rose. Stay with it, stay with it, stay with it. Quite when you sell, it's going to be up to you there. But then the price comes back, and again, this is potentially another buying area here, with the moving average really starting to rise here. But I won't give you, I won't go too much into whether it's buy and sell and things like that. I just want to really explain what the indicators are on this chart. So let's just zoom in again a bit here to have a look at the details. Now you have also some other chart facilities here. So I'll just go back to the default here of 50, not 150, let's go 50. We've got fib levels. This stands for Fibonacci. Fibonacci, golden rules. You can read up about Fibonacci and so on. A lot of things in science are Fibonacci ratios, and you can read up about Fibonacci ratios. And a lot of traders use Fibonacci ratios. They will say if a price has gone up, so we've got a starting price here, a high price here. If we come back 61.8%, one of the Fibonacci golden rules, then you would expect potentially some buying to come back in here, and it hovered around this point and then took back off there. There's also a 50%, and so when that hit down the 50%, it had fallen 50% between this high and low between those 2 points, and again that was a strong buying signal. Let's see if this will work for other areas. I don't want to get too caught up on this, but 100% was that high point there to this low point here. That's a bit tricky because they're on real spikes, so you fairly well consider those to be abnormal transients. They're high spikes. Probably you wouldn't go too much on those for trading. But if we go, let's look here. So we just take this low, this high, 100% difference there between that low and that high. And again, we can see here it fell back 50% at this point, and this became a buying point, and up it rose again. If we just zoom in again, see if it happens again. So here, high to low, 50%. Well, it was a pretty indeterminate chart there. It wasn't going in any particular trend, so that's a tricky one to go with. Let's just come back out a bit. Here we've got a moving average going up quite nicely over this time frame, quite a wide time frame here, especially for trading cryptocurrencies, which can be all over the place. But we go from the low to the high there. We come back 50% back on this point here. That was a clear buying point there. You got the 61.8% again, hit down there, went back up, then came back down, back up, and came back down to the 50%, and so on. So you have some fun with that. I won't go too much into Fibonacci. So that's Fibonacci, fib. Bollinger, also very popular for traders. Bollinger, a mathematician who basically came up with the Bollinger Bands. And basically the Bollinger Bands are to help show when a stock is overbought or oversold, plus also to help show the volatility, how much is the price moving, and therefore it can reflect some caution if you're, it can be overbought and oversold. Let's zoom in, let's give a proper explanation of this a bit better. So with Bollinger Bands, you've got a high band, a mid band, and a low band. That's the bands you get with Bollinger. So we've got the 3 blue lines here. Now, essentially, the Bollinger Band will expand as the volatility increases. So as you get a bigger change in price over a period of time, then the Bollinger Bands will move out and they will give you more space. Let's have a look here. So the Bollinger Band between this high point here and this low point here is very, very wide, and that's because the volatility, the price moved hugely there. But essentially Bollinger Band says if you're outside the lower of the range, then the chart starts going to come back in. It will aim back towards the middle of the Bollinger Band. So on this, and it's always very easy to look at charts after an event and say, oh yes, well that's obvious, and you can kind of, it's the cognitive therapy, cognitive dissonance, sorry, is the proper phrase for that, where you start to see things. It's like people who see patterns on Mars and on the moon, and they say that, well, it looks like a kettle or it looks like a face. Human pattern recognition, the brain is very powerful at doing that. But here we go, we come outside the Bollinger Band, a long way outside, so you could therefore say, right, we're going to come back into the Bollinger Band, and there would have been a buying signal down here or anywhere outside this Bollinger Band. And lo and behold, we go back in. It follows the Bollinger Band a little bit, then goes back up to the top. That would be overbought, and therefore you would sell. Price comes back down, comes all the way back down here. Price oversold, back in buying, up it goes again there. Overbought, back to sell, and so on. And you can see that does work quite nicely for this particular zigzag structure through this particular point here. I think that mostly covers everything. Oh, below here we've got what's called the MACD, the moving average. Can't remember what the CD stands for at the moment, but the moving average, and you'll see the general consensus, whether the price is generally being bought, which you'll get green charts here, or red if it's generally being sold. It's fairly obvious from the candlestick chart, but it will give you these trends here. So it tends to go bought, sold, bought, sold, bought, sold, with a reasonable regularity. But then it will always change its decision when you think it's not going to change its decision. And this is also called the RSI, the Relative Strength Index. So as the price comes right down here on the relative strengths, we're looking at this chart round here, we can see this is right down, and you'd expect the price to come back up from this point where it's gone so far to that extreme relative strength indicator. So there were lots of people with good buying signals here. It was out the Bollinger Band, it had dropped in price rapidly, it was the relative strength was a very negative, so therefore it would come back in price. So that would have been a great place to buy there, and then going back up to being bought. And again, look at where the chart has gone there, the relative strength indicator back at a high, it's hit the Bollinger Band, and therefore people started to sell it, the professional traders as it were. So hopefully you found that useful. Hopefully it's given you a bit of a crash course in the charts here. Let's just put this back to the normal settings, and whatever you get used to, but have fun. If you found this video useful, I'd really appreciate your comments. Do ask me any questions you've got as well. Help me, encourage me to do any other videos that might be useful for you. This is Paul Hardingham from paulhardingham.com saying thank you very much for watching.